G'day guys, this ASX trading tip is going to be on share splits and consolidations, understanding what they are and how they impact stocks. Here's a quick example of what consolidation looks like. We have a company here that has 16 shares available and they're worth $1 each. So the market cap is $16. You decide to buy 2 shares, meaning you own $2 of this company. Now they decide to do a 2-to-1 consolidation, meaning for every 2 shares that exist, become 1. This is what the company now looks like. They only have 8 shares available. Your 2 shares becomes 1, but you still own a same percentage of the company. You still own the same slice of this pie. And your valuation doesn't drop. So you own $2 here, and now you own $2 still. So that's what a consolidation looks like. So why do companies do consolidations? Well, sometimes they end up with too many shares on the market. And if you look back at my ASX trading tip number 2, you can see the impact of the shares on the market when there's too many of them. Here's an example of DeGray Mining, or DEG. Now the stock price here was $0.001, which is the absolute lowest a stock price can be traded at. Then it ticks up to 0.002, then 0.003, because they had billions and billions of shares. Now if we have, let's say, this company before consolidation had 3 billion shares. So at 0.001 share price, these guys were worth $3.3 million market cap. And if they moved up 1 tick, they'll be worth $6.6 million. So you can see the problem when there's too many shares on the market. There's a huge tick in market cap for just simply moving up 1 pip. In order to alleviate this problem and make the stock more enticing to future investors and just make it more tradable in general, a company will pull out a consolidation/split announcement, which is a ASX template and it's quite ugly. So we just skip down to section 4 and it shows us the ratio that they do the consolidation at. In this case, it's 20-to-1. And in section 5, it shows us the pre-consolidation shares, which is 3.3 billion, and post-consolidation is 166 million. And we can see the impact of this once the consolidation happens, and it just looks like a regular tradable stock now because of the sheer number of shares that have been reduced. And you can see it just becomes a regular tradable stock now. At first, it sounds like a really good thing to do consolidation, but really all it does is enable a company to do more capital raising in the future more easily. Using our original example, we were happy both pre and post consolidation because ultimately our portfolio didn't change. We had $2 in the company here and $2 in the company here. But over time, the company will run out of money, just like every ASX listed small cap and micro cap stock, well, almost all of them. They'll run out of cash and they'll need to issue shares and get money in return for it. In other words, they'll need to do a capital raising. So this green here represents the issued shares through capital raising. And you might be wondering, well, isn't our stock still worth $2? And the answer is no, because, well, these are all 16 million market cap. The value of the business doesn't really change. We just get more diluted when we issue more shares, which means the value of our stock reduces in order to keep the same market cap, assuming the business hasn't grown. Coming back to our example on DEG, or DeGray Mining, we can see that they ended up with 166 million shares at the end of December of 2016. Today, in 2020, they have 938 million shares according to the latest 3B. What this means is if we invested $10,000 at 3 cents in December 2016, the value of our holdings would drop to 1,773 purely from the dilution. In order to break even, we'd have to be at 17 cents. So we can see over the years, it did have a bit of a boom, but the price did actually eventually almost drop back right to 3 cents. I think the lowest point here was 3.5 cents. Meaning anyone holding from 3 years ago $10,000 worth would be sitting at $1,700. That's a huge drop in value. We can see here that the price actually did shoot up. This would have been the break-even point after 3 years, 17 cents. they would just barely be sitting in profit right now. If you're ever looking for a reason not to invest in small and micro-cap stocks, this should be it. Thanks for watching, guys. If you want to follow me on Twitter, I'm at demoniaco.au, or if you want to say thanks, feel free to drop by patreon.com/ASX tutorials.